In about 90 minutes, one number decides whether the Federal Reserve does something it has not done in years: raise interest rates into a job market that is already cracking. The warm-up number missed by nearly half. 3 Fed officials are already voting to hike anyway. Here's what your money needs to know before 8:30. Step back and look at what is actually happening. The institution in charge of keeping prices stable and employment full cannot agree on which problem it has. 9 members of the Fed's committee voted to hold rates at 3.5% to 3.75% last week. 3 voted to raise them immediately. That is the most unified push for a hike from inside the Fed since September of 2016. And they are making that push while the private hiring data rolls over. Today's report is not just a scoreboard update, it is the tiebreaker in an argument the referee is having with itself. When the referee is split, markets price the confusion, and you live in the result. Here's the shape of it: the miss, the split, and the stakes. First, the miss. On Wednesday, ADP said private employers added just 44,000 jobs in July. Wall Street expected 75,000. That is the weakest month since January, and barely half of June's 95,000. But inside that weak report is the reason the hawks will not back down. People who switched jobs got paid 7% more than a year ago, the fastest pay growth for job switchers since August of last year. Hiring is cooling. Pay for scarce workers is not. That is the exact combination that keeps inflation fighters up at night. Second, the split. Cleveland's Beth Hammock, Minneapolis's Neil Kashkari, and Dallas's Lori Logan all dissented last week, each voting for an immediate quarter-point hike. 9 colleagues outvoted them. Markets did not ignore them. As of last night, futures put the odds of a September hike near 62%. Not a cut, a hike, with hiring slowing. Third, the stakes and the thresholds that matter this morning. Consensus for today's official number sits around 83 to 85,000 jobs, with unemployment expected at 4.2 or 4.3%. Street forecasts run from 75,000 at the low end to 100,000 at the top, which tells you how little conviction anyone really has. The banks watching this closest say the line runs between 80 and 100,000. Print above 100,000, and September hike odds firm up. Print below 60,000, and those odds break down hard. One number, 1 hour, and the entire rate path for the fall gets repriced. Now, put the market around that number. Thursday was quiet on the surface. The S&P down 0.2%, the Dow off about 460 points from a record, the Nasdaq basically flat. But look underneath. Gold is sitting at multi-week highs above $4,300. Brent crude climbed toward the low 80s on Strait of Hormuz shipping risk, even with Iran and Oman floating a corridor deal. And JP Morgan's Jamie Dimon spent Jobs Eve warning that margin debt, money borrowed against stocks to buy more stocks, is at record highs. Calm tape, hedged positioning, record leverage. That is a market holding its breath, not a market at peace. The calendar: after today, CPI on August 12th, Fed minutes on the 19th, and the decision itself, September 15th and 16th. So what does this mean for your money? 3 things, not advice, just the map. 1, if the hawks win, variable rate debt pays first. Credit cards, home equity lines, adjustable mortgages, small business loans, all of it prices off the short end the Fed controls. A quarter-point hike is not abstract if you are carrying a balance. Know which of your rates float before September, not after. That one piece of homework is worth more than any prediction you will hear today. 2, the flip side is yield. Savers have been collecting real interest for 3 years, and a hike extends that. Cash paying you while the argument plays out is not a bad seat. 3, leverage is the fault line. Record margin debt means a surprise in either direction moves faster than fundamentals justify, because forced sellers do not wait for nuance. If today's number shocks, the first hour of trading is positioning, unwinding, not information. The empowering part, you know the thresholds now. Above 100,000, hike odds firm. Below 60,000, they break. When the number crosses the wire at 8:30, You can read it like the desks do, instead of waiting for someone to tell you how to feel about it. So here's the question I keep coming back to. Should a central bank ever raise rates while hiring is visibly cracking, or is that exactly when discipline matters most? I mean that as a real question. The dissenters are not fools, and neither are the 9 who held. Tell me where you land in the comments. Blue pill, trust the committee. 9 beat 3, the system worked, and today's number just fine-tunes a machine that is basically functioning. Red pill, a split Fed is not a functioning machine. It is 12 people guessing, and the people who pay for a wrong guess are the ones with floating rates and no vote. Either way, the number hits at 8:30. You now know exactly what to watch and what it means for you. That puts you ahead of most of the market's mood swings today. The timeline keeps moving. We will see you in the next one.